Most business owners are unknowingly leaving thousands of dollars on the table by missing key tax deductions. In this video, you'll learn how to legally reduce your tax bill by taking advantage of deductions you didn't even know existed. Stick around because understanding these strategies could save your business a fortune. Tax deductions are an essential tool for lowering your taxable income, but how do they actually work? Section 162 of the Internal Revenue Code outlines that business owners can deduct any ordinary and necessary expenses incurred while operating their business. This means any expense that helps keep your business running can potentially lower your tax bill. For instance, if your business makes $500,000 in revenue, but you spend $250,000 on business expenses, you only pay taxes on the remaining $250,000. Many business owners make the mistake of calculating their taxes based on total revenue, not net profit after deductions. This can lead to overpaying. It's vital to understand how deductions reduce taxable income and how missing even a few can cost thousands. Throughout the rest of this video, the most overlooked and beneficial deductions will be covered to ensure you're maximizing your savings and paying only what you truly owe. The pass-through tax deduction and business vehicle expenses. Pass-through entities like sole proprietorships, LLCs, partnerships, and S-Corp qualify for a significant deduction known as the 20% pass-through tax deduction. This allows business owners to deduct up to 20% of their taxable income. For instance, if your business earns $100,000, you can reduce your taxable income by an extra $20,000, significantly lowering your tax burden. However, eligibility depends on various factors, so consulting a tax professional is essential to ensure you meet the requirements. Next, there's the business vehicle expense deduction. If a vehicle is used strictly for business purposes, you can deduct 100% of its costs. If used for both personal and business reasons, deduct the portion of business-related use. Additionally, if your vehicle weighs over 6,000 pounds, you may be eligible for bonus depreciation, allowing you to deduct a large portion or even the full cost in the first year. Tracking business mileage or expenses is key to maximizing this deduction. Next, we'll explore how travel and meal expenses can further reduce your taxable income. Business travel and meals. Business travel offers a great opportunity to lower your taxable income. All travel-related expenses for business purposes, including flights, accommodation, and transportation, are 100% deductible. For example, if you attend a 5-day conference in a different city, the full cost of getting there and staying for the duration of the event can be written off. However, be cautious with personal vacations. Any days spent on personal enjoyment can't be included in your deductions. Business meals, another common deduction, were temporarily raised to 100% for 2021 and 2022, compared to the previous 50% limit. Whether dining with business partners, employees, or prospective clients, these meals are deductible as long as the primary purpose is business-related. Be sure to keep receipts and make note of who attended and what was discussed. Accurate record-keeping helps in case of an audit, ensuring that these deductions are valid. With meals and travel covered, let's move on to maximizing the home office deduction. Home office deduction. For those who work from home, the home office deduction can be a valuable tax-saving tool. If part of your home is used exclusively for business, you can deduct a portion of home-related expenses such as utilities, insurance, property taxes, and even repairs. The deduction is calculated based on the percentage of your home that is used for business purposes. For example, if 10% of your home is used solely for business, you can deduct 10% of these expenses. It doesn't matter if you're handling administrative tasks, client meetings, or daily operations. This deduction applies as long as the space is used regularly and exclusively for your business. It's essential to keep detailed records of these expenses, especially as more businesses transition to remote or home-based work environments, making this deduction more relevant than ever. Now let's see how your cell phone and technology purchases can work for you at tax time. Cell phone and office technology expenses. If your cell phone is used for business, you can deduct its costs, including service provider fees and additional charges like data storage for business files. The key is to ensure that the phone is used for legitimate business purposes. If the phone is used both for personal and business reasons, only the business-related portion can be deducted. Similarly, office, administrative, and technology expenses can make a big difference in your tax savings. Office supplies like pens, notebooks, and computers, as well as software for accounting or customer management, are fully deductible. For instance, if you buy a new laptop for work, the cost can be deducted in full. Don't forget about administrative expenses like payment processing software or merchant accounts, which are also eligible deductions. These small everyday expenses can add up quickly, so tracking them throughout the year ensures you're prepared when tax season arrives. Startup costs, self-employment taxes, and retirement contributions are up next, and they can provide even more savings. Startup costs, self-employment taxes, and retirement accounts. For new business owners, startup and organizational costs can be a substantial initial expense. Luckily, up to $5,000 of these costs can be deducted in the first year of business. Startup costs include any fees related to setting up the business, like market research, legal expenses, and registration fees. Meanwhile, organizational costs include those associated with forming your entity, such as legal fees for incorporating or creating an LLC. Business owners also need to be aware of self-employment taxes. Sole proprietors, LLCs, and partnerships pay 15.3% in self-employment tax, covering Social Security and Medicare contributions. However, businesses that elect to become an S-Corp can avoid this tax, although S-Corps do have other requirements, like taking a reasonable salary. This can lead to significant tax savings for businesses earning more than $50,000 a year. Business owners can also take advantage of retirement accounts, like SF IRAs and solo 401(k)s, which allow for much higher contributions than traditional retirement accounts. Contributions up to $58,000 annually can be deducted from taxable income, helping business owners reduce their tax burden while preparing for retirement. Finally, we'll break down health savings accounts, labor costs, and the cost of goods sold to complete your tax-saving toolkit: health savings accounts, labor costs, and cost of goods. Sold contributions to health savings accounts, HSAs, are another excellent way to save on taxes. HSAs allow you to deduct contributions from taxable income, and as long as the funds are used for qualified health expenses, they remain tax-free when withdrawn. This creates a tax-efficient way to cover health-related costs while reducing taxable income. Labor costs, including wages for employees and payments to contractors, are fully deductible. Make sure to collect W-9 forms from contractors and issue 1099-S at the end of the year to stay compliant with IRS regulations. Proper record-keeping ensures that wages paid are accurately deducted from your taxable income, helping to lower your overall tax bill. If your business sells products, you can also deduct the cost of goods sold, COGS. This includes the cost of raw materials, labor, and storage expenses involved in creating the products you sell. For example, if you manufacture and sell custom mugs, the cost of the materials used to create each mug is deductible. This deduction helps offset the cost of doing business and can greatly reduce the amount of taxes owed. Now, here are key tips to ensure you're maximizing every deduction available to you. Key tips for maximizing deductions. Maximizing your tax deductions starts with one simple rule: keep detailed records. Every expense you want to deduct needs proof, so hold on to your receipts, invoices, and statements. Whether it's a business lunch, travel expenses, or office supplies, make sure you track everything. Don't forget to note the purpose behind the expense, especially for things like meals or travel. This way, if there's ever a question or audit, you'll have everything ready. Next, it's important to consult a tax professional. Taxes can get tricky, and there are always updates to laws that might affect what deductions you can take. A CPA or tax advisor can help you avoid mistakes that could cost you money or put you at risk of non-compliance. They know all the small details that could make a big difference in your tax return. Finally, consider using tax software to simplify the process. These tools can help you track your expenses, categorize them correctly, and even remind you of deadlines. Some software can sync directly with your bank accounts, making it easier to stay organized throughout the year. It's a small investment that can save you a lot of time and money when tax season rolls around. What's the most surprising tax deduction you've heard about today? Drop your thoughts in the comments. If you want to keep saving on your taxes, check out our other videos for more smart tips. Don't forget to like, share, and hit subscribe, and tap the notification bell so you never miss a new upload.